Want to bring in research and bank analyst at Vertical Group, Dick Bove, is with us this morning. And Dick, it's good to see you, sir. Thanks so much for joining us.
Thank you, Maria.
What are you expecting in terms of the big drivers of the quarter at J.P. Morgan? Have your expectations come down?
Well, this has been a kind of sloppy quarter for the banking industry because, as just noted, you haven't had the ability to sell a lot of products. I mean, the growth in commercial loans, which was about 10% 2 years ago, is about 2% now. Commercial real estate loans are not at the hot pace they were at the last couple of years. Credit card loans are hanging in there at about 4 or 5% increase. But in general, we're not seeing any strong growth in loans anywhere. In addition, you've got this problem with trading where it could be down 15%, it could be down 20% year over year. So none of these numbers are particularly strong. Where the banks are going to be able to perhaps pull out the quarter is that they may get slight increases in their margins, they'll keep their costs lower, and therefore, they'll have a moderate increase, I think, for the quarter in both cases, but not exciting in any way.
But, Dick, this is Lindsay Bell. Is that going to be enough to move J.P. Morgan stock, for example, even higher? It's up 10% going into this print, which is a very impressive move in a one-month time span, I must add. Is this going to be a sell the news type of event?
Well, I think that, these stocks have been moving in the past month. That move has nothing to do with the fundamentals of the companies. In other words, bank stocks did really poorly through most of the summer. In other words, if you go from their peak in March, on March 1st to roughly, we'll say, September 1st, they were down in an up market. So they were doing some catch-up, we'll say, in the month of September. But, generally speaking, bank stocks have underperformed the market, and therefore I don't see that this is I don't see that anything is going to happen here with earnings which would either get people very enthused about them or get people very depressed about them.
Well, in the last year, the financial sector in general is up 33%, which is the best in the S&P 500 index. So I'm sitting here wondering how much higher can these financials go? It seems like the rotation into them happened in the last month, like you just said.
Yeah, again, you had a huge move in these stocks from November 8th to March 1st. And then they died. They just stopped moving whatsoever. So the move that you got from, November to March was based upon the fact that they had been underperforming prior to that. Then, as they say, they died. Then now they seem to be coming back. But the fact is that their fundamentals have been pretty weak and pretty, if you will, showing moderate gains through this whole period. So the stocks are jumping up and down all around the fundamentals, but the fundamentals are not suggesting that you should be going out buying these things aggressively.
Okay, Dick, so I'm wondering what that tells us about the economy. You and Lindsay mentioned this slow loan growth over the last year. Are we still not really seeing a Trump bump other than expectations? What do you think the economy is doing here?
Yeah, I think you're exactly correct. I think that expectations remain extremely high. Obviously, a tax cut potential, a big infrastructure spending bill, all those things keep expectations relatively high. But if you look at what the banks are doing day after day, week after week, they're not seeing it. In other words, businesses are not going to their bankers and saying, we have all these plans, we're going to make all of these investments, we need to borrow more money. They're going to, the banker and saying, we don't know what our tax rate is going to be next year. We don't know, how the economy is going to be doing, so we don't want to borrow any money. And they've been holding back. There's just no sign coming from the business community to the banks that things are getting better.
Given the state of the banks, Dick, it's Dagan McDowell with loan growth decelerating. What does that say about the broad economy? Because the most recent reading, we had a U.S. economy growing north of 3%. Does it look much worse in the quarters ahead?
Again, if you're just looking through this one very limited prism, which is bank lending, it says that the economy is not going to grow at 3%. It is indicating that the economy might have difficulty staying at 2%. But again, there are a whole bunch of other influences on the economy than just what banks are doing. But I'm repeating too much here, but the banks are not growing.
Let me ask you, Dick, there were some expectations on the impact of a tax cut plan. So, a couple of analysts were saying that a 5% decrease in the corporate rate is equivalent to 5 to 8% on earnings upside for the banks. What kind of upside do you see in the banks if, in fact, we were to get this tax cut plan year-end or perhaps first quarter 18?
Well, I think it's too early to say, given the fact that we don't know what they're going to do with interest rate deductions. In other words, if corporations lose the ability to deduct interest rate on their tax forms, then basically that's going to lower loan volume. If banks, are going to have to be impacted by their inability to take an interest rate deduction on their, if you will, tax forms, that's going to have a huge negative impact on the banks. So, we don't know. We don't know what's going to happen with this interest rate deduction issue, which is a huge one for the banking industry. If we say, okay, there's not going to be any interest rate deduction and all we're going to see is a cut in the tax rate, then of course the banks will benefit. But it doesn't look like it's going to be that simple.
Yeah, go ahead, James.
Dick, I'm just wondering from a taxpayer perspective, I know shareholders obviously have been excited about banks since election night, but as these companies are returning more capital now, we got the 10th anniversary of the financial crisis next year. Should taxpayers be concerned?
Well, I think that this whole concept, which has swept, if you will, the industry, which is to pay back more than 100% of earnings in payouts through stock buybacks and dividend increases, is a horrendous mistake. To me, it's the same as Jamie Dimon going to the top of his building on Park Avenue and throwing money down in the street to people who don't want to have anything to do with the company. Bank earnings are based fundamentally on increases in capital. You can't give away your capital. And particularly, you can't give away your capital in such a fashion that you lower the growth rate of the institution. It's a huge mistake.
Real quick, Citigroup, JP Morgan are both out. Any expectations in terms of Citigroup? You told us about JPM, $25 billion in revenue is what you're expecting. Any takeaways in terms of what we should be looking at Citi?
I think in the case of Citi, you're looking at a company which has not yet reached the point where it can grow revenues in a meaningful fashion. I think that, this is a company which hopes to get 3-4% growth in revenue because the underlying businesses which it has are not growing that rapidly. The whole story with Citigroup is, again, the whole buyback story. In other words, they've promised to give people $20 billion a year in buybacks, and, I think that's crazy.
All right. We will leave it there. Dick, always a pleasure. Thank you so much.
Thank you.
Dick Bove joining us there, and we've got